Hi friends, welcome and today moving on to one of the most pertinent topics for at least the next couple of days, and you would see the media going all over these numbers or these terms. So what we thought was, let's try and understand what do you mean by the concept of trade and fiscal deficit from a conceptual standpoint, and also try and understand where we are in India as far as these particular measures are concerned. Moving on, I would sincerely thank Tirmal, Harish, and Jugal for getting the presentation done. I believe it's come out really well. We've got a fairly comprehensive agenda. First, we'll try and understand the relevance of these terms and what is the reason why these measures come into existence, and how it is from an Indian context, and why these numbers are being you would see every anchor or economist using these terms going forward. Trade deficit, let's try and understand. As a word, trade itself refers to, it's the activity of buying, selling and exchanging of goods and services. You would have two types of trades: one with what happens within the country, which we call as internal or domestic trade, and what happens between countries, which is what we call as international or global trade. Now, this international trade has two components. One is what we call as export, and the other is import. Export is when we sell, import is when we buy. So, what is the relevance of international trade? Fundamentally, because this is of added relevance because of the new RCEP. The reason for India not signing up the RCEP, where it was said that it would go against us, but globally, the advocates of liberal economy um, advocate free trade across borders, primarily because it stimulates global development as well as development of the democracies or the economies which are open to such trade, makes use of abundant raw materials, creates job opportunities, trading partners have access to cheaper goods, enables disposal of surplus production capacity, stimulates competition, and more importantly, cooperation between geographies. So if one country is good at doing something, it will focus on producing more of that rather than trying to produce some quantity of everything. That would definitely improve its, uh, or I would say, reallocation of resources and investments. So when does a trade deficit occur? So for anyone who's running a business, if you sell for more than what you buy, it's a profit. What happens when you buy more and sell less, where you end up in a loss? We call it as trade deficit from an economy standpoint. So where the value of your imports exceeds the value of exports, we call it as trade deficit. Now this is uh, important for us to know, though the numbers are not very encouraging. Right from 1991, that's when we've done our research. India has had a series of trade deficits. We've never had a year of surplus of trade, and current year is also not very different. If you notice, friends, our trade deficits have come down from 11, 12, 12, 13 peaks, from 13, 14 and beyond, thanks to the oil price dip, because we are one of the largest importers of oil, and more than three-quarters of our oil requirements are imported from other countries. But this year as well, for the first 9 months, we are at $120 billion of negative. Ideally, we would end up between 150 to 160 for the year, which should be lower uh, than the earlier year of 182. Now, if you look at the trend, friends, see the blue line reflects the imports of India. We've had again the dip you would see is thanks to the correction in oil prices, and exports have also gone down. But now both exports and imports are growing, but unfortunately, the rate of growth of imports is higher than the rate of growth of exports, which is why if you see the red line below, which talks about the trade deficit, the deficit is only going down further. So by and large, it's not been a great successful ride, but what it has also done in the bargain is it stimulated significant amounts of growth. Because if you notice, our economy has jumped at least 5 to 8 times in the last 20 years. So we are talking about an effective improvement in domestic economy, or the expansion of the size of the domestic economy thanks to foreign trade. This is more than an empirical reason for us to promote free trade. This is a very interesting table, friends. If you notice, top 15 partners, trading countries of India, barring US, UAE, and UK. we've got a negative trade balance with literally each of these countries. The largest being China. I mean, this is all in crores, friends. So we're talking about our trade deficit with China roughly about being $35 billion or 250,000 crores. So, and Saudi Arabia again, oil is a primary reason. Iraq, it's oil. But you look at countries like Singapore, you look at countries like South Korea. I mean, again, it's electronic imports. Switzerland, talking about a minus 90,000 crore. We hardly export anything to Switzerland. So these are clear indications that the quality of our exports is not is nowhere commensurate with the quantity of our exports as well as the volume of the imports what we buy, especially in terms of oil. So there is a lot of catching up which needs to be done. We are also doing our understanding on regional trade agreements and India's trade agreements. So that would give you a clarity on what all agreements which India has signed and what's been the outcome. Now, if you notice, exports as a percentage of GDP and imports as a percentage of GDP. Primarily, this is where this difference is what is your trade deficit. So imports are about 19% and exports are about 12.4%. Again, friends, if you see the rate of growth of imports is significantly higher than the rate of growth of exports. Even you take the current year, we're talking about a 1.3% jump in imports, whereas your exports have just grown by 0.8%. And we are already talking on a GDP base of roughly about $2.5 trillion. So, point we're talking about a 1% difference. That 1% itself is a significant number at this base. Reasons and its impact. Reasons for trade deficit, obviously, as we've seen, our inability of our domestic market to compete globally, and the demand domestically is not entirely met by domestic production, so we are forced to increase our exports to keep up with the demand requirements. And the problem with imports is we are importing goods like toys, which are from China, from countries like China, which by and large a country of India's size and stature should be able to manufacture. Coal imports have also hurt us. We used to import coal even when we had coal reserves, idle coal reserves in our country. The major reasons: oil imports, gold imports. We are one of the largest consumers of gold, electronic goods, import of precious and semi-precious metals. Moving further, this would give you a good perspective, friends. 41% of our imports are from gold. We import anywhere between 6 to 800 tons of raw gold every year, and petroleum and crude products make up another 30%. So roughly about 70% of our imports are only between the two. Imagine the impact of renewables on our trade deficit. And then we import electronic goods, pearls and precious and semi-precious stones. So that's another 10%, roughly about pearls and is another 6%. So 75% are ideally, uh, except for petroleum, you could say it as non-essential imports. What is the impact? Our foreign reserves are always unrestrained, so we need to match up the trade deficit with foreign direct investments. Otherwise, your balance of payments and your forex reserves will only keep depleting by the year. Economic growth and stability is affected. Negative impact on domestic business, and Indian currency obviously gets devalued. So, if you notice the devaluation of the Indian currency from 1980-81, look at the way it has systematically got devalued over the last say 35-40 years. If you notice, let's take US dollar for example. What was roughly about 8 to 10 rupees, 10 rupees per dollar is now about 70 rupees a dollar. It has gone up 900% over the last 40 years. So every currency, and the primary reason being India is a net buyer of dollars because of our trade deficit. India's forex reserves, foreign currency assets in millions of dollars. So today we are roughly about $400 billion of foreign exchange balance, and tremendous pressure is being put on capital inflows into our country, because revenue flows, which will happen consequent to expansion of the export base, is not happening. Fiscal deficit, that's the other term which we all would be seeing the next few days. Okay, so what is a fiscal deficit? Again, as we saw, a government does not maintain a profit or a loss account. It maintains a receipts and a payments account. So the government budget is a document prepared by the government and other political entities representing its anticipated revenues and proposed spending for the current year. For the financial, when we say proposed, we're talking about till March 19, till March 20. So where the government's inflows are more than exports, more than expenses, we call it as surplus, and where it is the other way around, we call it as a deficit. And where, for some reason, very strangely, both these are equal, we call it as a balanced budget. The advantages of fiscal deficit, so where you try to spend more than what you've earned, is basically because it helps addressing public concerns such as unemployment at times of recession, expansion of public welfare, which definitely increases. Let's say if you keep feeding your population, you try and keep health costs at control. However, the concerns of excessive spending are the country's sovereign rating goes for a toss. The government picks up debts which at rates which would be expensive, and it would also mean a case for very populistic measures like large-scale loan waivers or projects without accountability. Fiscal deficit in India, if you notice, it's been a great conversation. I mean, topic for conversation. The government expenditure, again, when we look at, we talk about capex for public services and welfare, repayment of debts and loans. Again, friends, for those of us who come from an accounting background, it's a case for cash flow statement. It's you look at the fiscal deficit as an end result of a cash flow statement. So whatever be the inflows from to the government, um, minus whatever be the expenses. When we look at inflows, it will obviously taxes, interest receipts, other non-tax revenues such as income from public services, and then capital receipts is if there is any debt central government is given which it has received, or any income from those debts, recoveries of loans, and any expenditure is the other way around. Repayment of debt, loans and advances, public services and welfare, grants, capex for public services and welfare. So typically, we're talking about the entire expenses. But again, we're talking only from the central government's perspective, friends. Not we don't include the state government's data here. So the fiscal deficit number, whatever we saw last year of 3.3, is only the central government's fiscal deficit. The reasons: high levels of tax avoidance and tax evasion, but this is a statement which we make without empirical basis on what is the base or the minimum expected level of compliance. The government is engaged on significantly high spending on populist products, reduction in tax rates without bringing down government expenditure. On one side, you bring down income, the other side, you can't bring down expenses. But rationalization of tax rate would have been a far better alternative. Major hike in capex in the welfare of the country, but again, the average time for an infrastructure project in India to be completed is in excess of 20 years. What are we talking about? Failure to adhere to fiscal discipline. So if you look at India's fiscal deficit, friends, again, right from 1990, we've had only a deficit budget. Not only in terms of trade deficit, but we've also had a fiscal deficit, which is ballooned from 55,000 crores in 1990-91 to 634,000 crores to as we speak now. Those trends in the budget, fiscal deficit, again, friends, like what we saw for import and exports, the blue lines are your expenditure and the green ones are your incomes. Despite the fact that we've had a good increase in receipts, our expenses have also spiraled considerably, which is why our fiscal deficit has constantly been enlarging. And to bridge the gap, the government has only been leveraging its balance sheet and credibility to expand. And what we also need to understand is this fiscal deficit is not considering off balance sheet items like debts of Food Corporation of India and other government bodies. It also excludes state government deficits. So if you were to include that, we're talking about a fiscal deficit of anywhere upwards of 8 or 9%, as against the 3.3% which has been publicized widely. Impact of fiscal deficit in India. So consequent to a case of shortfall in receipts, we are constrained to borrow from the market, and there are only two sources: either we borrow domestically or we borrow overseas. or from Reserve Bank, but RBI has a power to issue notes. But what happens when the notes issue? It increases money supply and increases inflation, and also the value of the currency also comes down. So technically, the only way of creating new money is where the value of the assets held by RBI expands, and not the number of instruments which represent its assets. Uh, what are the concerns of fiscal deficit financing? You get into a debt trap. Like someone who borrows to repay interest, the government will effectively happen. See, today, if you notice, India's interest cost, which is roughly about 6.5 lakh crores, equals the fiscal deficit for last year. And this year, going forward, from what we understand, the interest should be lower than your fiscal deficit, which effectively means we need to borrow for repaying 100 rupees of interest, we'll end up borrowing 120. So you're effectively borrowing to repay interest. So when would you ever stay afloat is a serious cause for concern. Financing of fiscal deficit, if you notice, the largest contributor has been the market borrowings. Overseas finances have not been that great a contributory, and we've been repaying overseas debt. Because one of the thought processes last year was where the finance minister said, we shall be borrowing abroad in foreign currency. Thankfully, good sense prevailed, and we didn't move on in that direction. Otherwise, given the fluctuation in in the rupee exchange rates, we would have had a serious uncertainty in defining the quantum of our exchange. Other borrowings, and when we say other borrowings, it talks about small savings, state provident fund, special deposit reserve funds, treasury bills, etc. So these were some of our thoughts, friends, on an area of relevance perennially, but more so during the budget season. We hope you would have enjoyed listening to the content. Thank you, and see you around very soon tomorrow for the budget presentation. Thank you.